rule. Okay. Good morning, everybody, and welcome to the Senate Finance and Appropriations Committee. I especially want to say hello to the members of the public who have joined us. These are unusual and difficult times, and I hope you all are more adept with Zoom than some of us are. But we are now all on, and I want to welcome you. I'd like to call us to order and ask April to call the roll.
Thank you, Madam Chair. Senator Saslaw.
I think everyone's muted, right?
Yes, I'll check Senator Saslaw. Senator Norman.
I'm here.
Got Senator Norman. Senator Hanger.
I'm here.
Senator Lucas.
Here.
Senator Newman. No, he's here. Senator Ruff.
Here.
Senator Vogel.
Here.
Senator Barker.
Here.
Senator Edwards.
Here.
Senator Deeds.
Here.
Senator Locke.
Present.
Senator Peterson. I can see him. Senator Marsden. Senator Eben.
Here.
Senator McClellan.
Here.
Madam Chair, you have a quorum.
Thank you. Before we start with the agenda, I'd just like to go over a few virtual meeting etiquette policies. Please mute your phone when you're not, or your computer when you're not speaking. If you are using the video link, there's a microphone symbol to push to mute. If you're using a cell phone or a regular phone only connection, then you can use the symbol on your phone or *6 to mute. Please introduce or announce yourself so we'll know who's speaking. I recognize most of your voices, but maybe not all of them. And please remember that the meeting is being recorded and it may be possible for the public and/or members to see you. If you are using the video link, please turn off your camera if you need to step away for a few minutes. Now, turning to the agenda. First, we have Secretary Lane here to update the committee on the May revenue report. This is going to be followed by Ellen Mons from DMAS to discuss the changes to Medicaid in response to COVID-19 and an update on Medicaid enrollment and spending. And we'll conclude with a staff presentation on the federal relief funding. So now I believe I saw Aubrey is here with us. And Mr. Secretary, if you could give your report.
Thank you, Madam Chair, and good morning to all the members of the committee. Looks like some of you are in a much better place than I am, so I'll try to go through this relatively quickly. And just so the members know, your staff is going to help me in terms of moving to the next slides. So we'll go to the next slide here, please. So what I'm going to do today is pretty normal for the Money Committee update, although I will spend a little more time on national and state economic indicators than I normally do. As I mentioned last time, these are going to be very indicative of not only where we've been, but where we're going. Once we get through those, we'll go through obviously the numbers in detail, the various components of the revenues for the Commonwealth, some next steps, which will include an interim forecasting schedule that we've laid out, which will probably lead, I know the governor will work with the leadership on picking a date for a potential special session to deal with the forecast and any applicable budget adjustments. And then I know you're going to have a presentation I heard on federal assistance, but I'll give you a brief update of what's happened here from actions taken in the governor's office. So next slide, please. So as I said, we normally don't spend a lot of time on these, but as I mentioned last month, these are going to be very, very indicative of sort of not only where we've been, but where we're going. And I'll point out that this month is a completely different set of facts than we had last month, at least in terms of where we may be going. So although this is the second monthly report containing the impacts of COVID-19 and the outbreak, it's the first one where we had a full impact of the outbreak on our revenues. Just again, we are a part, obviously, of what's going on nationally, although I think more so than in other times, you can't always look at the national picture because states are dealing with this COVID virus differently and are in different stages of opening up. So a lot of times we can tend to take a look at what's happening nationally and then say, well, that could be the same trend in Virginia. That's not always the case here as we move forward. But certainly the entire nation did see a pullback from the closures of businesses and the layoffs related to the COVID virus. And you can see there, it was pretty broad based, and our gross domestic product is projected to fall 5% for the year, but that's a little bit, not really indicative of what's going on, because in the second quarter alone, it looks like the economic decline is going to be close to 42% across the nation. And that 5% indicates that we'll be coming out of this slowly in the second half as we go forward here. The good news to that is it appears that based on where other states are, and it also relates to Virginia, that we may be at the bottom. It doesn't mean it's going to be a quick rebound back, but it does appear that we are pretty close to the bottom in terms of economic activity or the lack thereof. And that was indicated by the surprise announcement, that third bullet, that we actually increased 2.5 million jobs in May across the country, where economists were expecting another decline of 7.5%. And it was pretty broad based. Nearly all states, and it does include Virginia, added jobs or added people back to the payrolls in the month of May. And a lot of that had to do with the states opening back up in their economies. And many of those jobs were recalls of people that had been laid off. Now, that allowed the national employment rate to fall, and was expected to go back up. And many thought it may hit 20% at some time. It was reduced to 13.3% in May. And it indicates that there was a lot of actual rehiring and anticipation of rehiring. I think a lot of that had to do with the payroll protection plan, as businesses kept their employees on their payroll in anticipation of opening back up when their state or their governors allowed them to do so. But I do remain cautious as we move forward, because I do think while we have started to see an opening up, I don't think it's going to be a uniform, just straight up. I think there will be some starts and some stoppages along the way, depending on how each state reacts to the virus. And that's still going to be key. The virus is still going to dictate the course and determine the pace of economic activity and its impacts across the nation and in the Commonwealth also. But we did see that obviously because of that increase in jobs, that the number of people filing for unemployment benefits continued to decline. And that was the case here in Virginia also, although they still remain at very, very high levels. But over half the states had initial claims that were falling. And as I said, that has bolstered some economists to see a little better increase in activity in the second half. Now the consensus is somewhere between 11 and 12% growth in the second half, that being July 1st through December as we go forward. So the key here will be, has the national economy actually hit a bottom? It appears that's the case, although that's going to be very much dependent on what happens with the virus. Is there a second wave, or as many say, we're still not out of the first wave, and that appears in some states to be increasing. Although the monitor that I look at mostly is hospitalization utilization, And that has not been trending nearly as negatively as some of the initial claims. And some of that has to do with additional testing that's been going on, in addition to the virus maybe spreading a little more quickly in some other states. So what's that mean? Well, the good news is that all businesses were very much in the mode of opening back up in May, and that included the most hardest hit, like restaurants, air travel, hotel bookings, and actually gasoline consumption. I'm not suggesting to you they're anywhere close to normal levels, but I am saying that they are coming off the bottom. And that may be very, very helpful in terms of public confidence, because as we've said all along, that this is really not going to be a recovery led by government. It's going to be led by individual businesses being able to demonstrate to the public that it's safe for them to come in and enjoy, whether it's a meal or whatever service they're offering. So a lot of the businesses are taking steps to make sure not only their employees, but their customers are safe. But of course, until we actually get a vaccine, or certainly a more significant therapeutic remedy for COVID-19, it's still going to be a very, very cautious public as we go forward. And many people are not expecting that we're going to get back anywhere close to the employment levels that we were before this happened until sometime probably in 2023, maybe as late as 2024. So I do believe it's going to be a slow mend upwards, but good news is maybe we're at the bottom. So next slide, please. As we move forward here, and let's see, can we go to slide 4? There we go. Thank you. As we move forward here, a lot of this benefit, or the ability for businesses to reopen, has been because of, I believe, federal policy, both monetary, with the Federal Reserve not only keeping rates near zero, but basically flooding the monetary system with cash and buying just about every asset out there to instill confidence in the public in terms of the financial markets. But also the fiscal policy of the Congress, that's also been a big part. I mentioned the PPP, or Payroll Protection Program. Certainly the unemployment benefits that are in effect through July 28th, the additional $600 a week, have certainly been a way to soften the blow, at least to the consumer and to the public, in terms of what this impact has been from the business closures in there. I don't want to move away from here to say that I do believe there's going to be a reckoning. We'll have to deal with it now, but the national debt was already an issue. It's going to continue to be an issue as we go forward, and will put a drag on economic growth in the future. Although I won't talk a lot about that now. That is something we're going to have to deal with. And as you know, a lot of payments on mortgages or rents or car loans have been suspended until such time as many of our citizens are back at work. They haven't been abated. They've only been suspended. So there will be a draw on our consumers as we go forward, as they get to catch up on some of the debts that have been deferred as we go forward. But nonetheless, we did see the impact of the Federal Reserve and the fiscal stimulus coming out of Congress. I do believe it helped to cushion what could have been even more severe impacts from the COVID-19 virus, at least in terms of business closures. That was apparent, again, not only in the national data, but certainly here in Virginia, because in May, even though this is will be reported normally next month, we saw the same thing that happened at the national level, that 78,000 people moved off the unemployment rolls and became either employed or are ineligible during the month. And our joblessness, or our unemployed rate, dropped from the 10.6% down to 9.4%. We still have 400,000 people that are jobless in the Commonwealth. I'm not saying by any means that it's a great situation, but it does look at least like we also may have hit the bottom, and we're starting to climb out of this in that. So the good news is that it appears that all that monetary and fiscal stimulus that the federal government did has been a benefit. In terms of public confidence, there was an article here recently that Central Virginia chief executive officers, almost complete change from where they were 60 days ago, now have an improved outlook for the remainder of the year. So hopefully that will be indicative as we look at our forecast as we go forward. So that's sort of the background. And the reason I spent a little more time on that is because the landscape has changed, particularly from where we were 90 days ago when we had a lot of uncertainty. Now we have a lot more certainty. I'm not suggesting too it's all good, but at least we'll have a basis to possibly judge a new reforecast on as we move into that over the next month or so. Okay, I'll get into the actual numbers. If we can go to slide 5, thank you. So as we stand today, we are about $800 million, not today, as of the end of May, we were $800 million below our forecast. And that's roughly $220 million below the prior year. Total general fund for the month decreased a little over 20%. And on a year-to-date basis, this is the first time in a long time that we have been behind the previous year. So we're actually behind the previous year. And again, as I said, substantially behind our forecast this year. Now, a lot of that has to do not only with the closure of businesses, but the timing of our federal tax payments related to our state income tax returns. So from an overall standpoint, May was very much about where we thought was going to happen, taking into that change in the timeline of tax payments into account. So with that, we'll get into the specifics. And the first one on page 6, if we can go to page 6, is the withholding tax collections. As you recall, last month, we didn't have a full impact of the virus, and we did have a couple of 2 extra days. Our withholdings were actually up for the month, where many people were reporting decreases. That was not the case in May. We were down 13%, but again, a lot of that had to do with 2 less payroll days that we picked up in April. So if you look at the 2 months combined, we were down about 4% for the 2 months. Now, the headline numbers we've been reading, and particularly in certain industries with the number of people being laid off, would indicate that we would be down a lot more than that. But really what it gets down to is the type of jobs that were impacted and the type of businesses that were impacted. And I have a couple of slides to detail that for you. But the overall is we are still increased over our projection because of the good showing we had at the beginning of the year. And I believe in June that's going to hold as we go through. So let's go through a couple of the details of why that's the case. We'll go to slide 7, please. What I have here is the payroll withholding of the firms that actually pay us, the breakdown of those firms and how large they are that actually pay us. And so if you look at this schedule here, dealers with 5 or entities that have $5,000 of monthly withholding equate to about $1.5 million in annual payroll. And those that are 5 to 10,000 in the monthly withholding are about anywhere up to about $3 million in payroll. So if you look at those first 2 columns, they represent almost 95% of the actual entities that pay us, but they only represent 24% of the dollars. So if you look at this, those smaller firms have had probably the largest impact as we go through and look at those people who've paid us. We have about 250,000 entities that roughly pay us payroll. And this overwhelmingly shows that the larger, when you adjust for the couple of days, the larger employers have been able to weather this storm much better. And if we go to the next slide, page 8, this really depicts it. What I've done here, or I've had the Department of Tax go through here and look at the collections or who paid us payroll withholding by payment size from the beginning of March through actually the end of May. And I have also a chart that I'll share with you that takes it through June the 15th. And what you can see here, and what's been most of the headlines, is it's the smaller employers that have had the largest impact to them in terms of layoffs and the closure of businesses. In fact, if you go over to the last column, those are the largest employers. They have over $30 million in payroll each year that they give us. They have been, if you look through that column, it says April 1 through May 31st, they have only been down in total 3.8%, 1.6%, you can see from April 1st to May 31st. They've only been down 1.6% versus the smaller people being down over 7%. Now that gives us our average of the 3.8% that we've been down as we look through that period. And if we look through June 1st through June the 15th, the larger employers actually increased payroll. They actually paid us more than we were projecting because a lot of that has to do with the federal government, the defense industry that has remained open, our technology companies that can work from home, and the essential industries that have remained open, like the food chain, compared to those industries that were hard hit, like the leisure industries, the Main Street businesses like restaurants, and some of the smaller firms in the rural areas. So while overall we've had a lot of people out of work and we need to help those, it has not been a significant impact on our revenues because most of those were in the smaller employers and the lesser payroll. So if you look at it, what I would suggest to you is before we went into this, our economy was strong, but it wasn't as broad-based. The social fabric underpinning it was very thin. And those lower income jobs and the smaller companies have been impacted much more than the larger companies have in this. They've been able, if you want to call it business continuity, the larger companies have been able to weather this a lot better. A lot of those companies did take advantage of the payroll protection plan. And of course, they kept their employers, the employees on the books as we went through this. So what I wanted to point out here, while the headlines have been significant people of unemployed, and again, that's not good. We want to get them back to work. And as we shift away from the COVID direct impacts to helping businesses get back on their feet, we need to concentrate on those employers. But in terms of it impacting the actual revenues, the Commonwealth, it's not a one-for-one hit. And so that's why you see unemployment has averaged well over 10%, but our payroll is more down in the 4 to 4.5% range because of the type of employee pay grade and the type of employer that was impacted most significantly by the closing. So I just wanted to make sure you can't really take the headlines and then interpolate that and say our revenues are going to be down by that same amount. And as I pointed out earlier, all of these employers have started to show an increase in economic activity. Many are coming, having employees coming back to work. As a matter of fact, when I said we still had unemployment, still 400,000 people looking, we have 12,700 people who have been called back to work that are looking for an exception. And I think a lot of that has to do with they are actually making more on the unemployment benefits because of the $600 increase they're receiving than they would if they went back to work. And I'm not suggesting that from a policy perspective. I'm only saying a fact. But many of our small businesses, we know anecdotally, are having trouble getting some of the employees back, not only because of the virus impacts, but because of the sort of the disconnect in policy between unemployment and calling people back. And I don't mean that in a policy perspective that I'm suggesting it's a change. I'm only pointing out to you as we move from this, those benefits expire the 28th. We could see additionally more people coming back to work as we move forward. So that's the story what's going on with normal payroll withholding. If we go to slide 9, this is where really the impact of the revenues have been felt the most. And this is our non-withholding tax collections. And as you all recall, we did move the tax filing deadline from May the 1st to June the 1st. So meaning that a lot of the revenues that we normally would have gotten would have come in April and before are now going to come in late May and June. And I'll also point out, remember we were dealing with the impact of the Tax Cuts and Jobs Act from a year ago. Our original projections had us being down $500 million through the previous year because we thought taxpayer behavior would change as they understood how to optimize between federal and state taxes. So if you look at this graph, the green bar is what we did in the previous year, and the blue bar are what we have done this year, with the yellow bar being the projection we would need to hit in the month of June to make our payroll or our budget in this particular category. The red stars you see were the original projections we thought were going to happen in non-withholding collections if we hadn't have changed our payroll date or our due date for taxes from May 1 to June 1. So we expected to get in about $930 million for the month of April, but we only got $470 million in because we moved the date. We projected $575 million in the month of May. We got about that, a little over $500 million for the month. So we did about what we thought. But in June, to make our budget, we would have to receive a little over $1 billion in the month to make our budget, not our projection of being down $1 billion, but our budget. In fact, if you looked at what we projected a few months ago, we would be down $1 billion, we thought, to our projections because of impacts of COVID-19. We collected $2.4 billion in June of last year. If we collect $2.4 billion, and I'm talking about total collections, not just non-withholding, we would be $900 million down to our budget. So going into the month, if we just did what we did last year, we would be down about $900 million. But we know we're going to do better than that because we moved the tax payment deadline into June. And so while we expected last year we did $1 billion and we didn't think we would get to that, today we have $850 million in the bank for this payroll withholding, with 8 days of collection still to go. Basically meaning all things being equal, and we collected $400 million last year, all things being equal, that instead of being down $1 billion, we're going to be down somewhere between $500 and $600 million, all things being equal. I actually think we're going to do a little better than that because we got 8 days still left to do in the month. So the moving of our tax collections or payment or receipt date for our tax returns, it appears that we're going to get most of that money. And what that does is not only is it good news for this year, and I should have started this by thanking the public and thanking our CPAs and certainly my Deputy Secretary, June Jennings, because I know it was a hardship on some of those people moving the tax returns a month in terms of not coinciding them with the federal return. And we couldn't do that because that federal returns are not due until July 15th, and our Constitution wouldn't allow that. So I apologize to the public and I appreciate their hard work and having to know to reconcile that. But I will tell you what it's done. It's allowed us not only from a fiscal standpoint to complete our current year, but it puts us in a much better position to be able to reforecast. I've talked to a lot of my counterparts around the country who have delayed the tax season to July 15th. They have no idea where they are and are not in a position to be able to reforecast. And we are. So the good news from this is that it appears that we're going to substantially get most of the monies that we thought were in this category. And we're going to end the year a lot better than being $1 billion down as we move forward. We had approximately 400,000 more returns that we needed to process in June of this year versus last year. And they have come in now. And it looks like we're well on our way to being very close to meeting our actual budget in this category. As you recall, before all this happened, we had an upward bias here anyway, because we use a collar to limit the impact so we don't over budget. And it looks as if that economic activity is going to result in additional monies coming in here. So again, this category alone gives me confidence that we're going to be well below being $1 billion down as we move forward into ending this fiscal year and starting the next biennium. Next, if you go to graph 10, here, this sort of just takes it in graphic form. We are actually tracking close to 2018 taxpayer behavior, which is what we should be doing if people understand how to optimize the changes we did last in 19 for the Tax Cuts and Jobs Act. So the behavior doesn't surprise me, other than it's coming a month later because we moved the tax date into that. So the good news is it looks like we were pretty good at estimating what the Tax Cuts and Jobs Act would be, and we were conservative in estimating the impact on this year's revenues. So I'm comfortable in saying that we're going to finish the year better than we thought we were just a few months ago, about 90 days ago. If you go to the next page, which talks about refunds, makes perfect sense that most of the refunds that were going to be happened before June 1st, because obviously if you were due money, you would file your return as quickly as you could. We processed about the same amount of returns through May 2.3 million individual returns that had refunds this year versus last year. And in fact, that probably is a small upside that could go into June, because last year we processed a lot of refunds. This year, it looks like most of those happened before June 1st. So overall, net individual income tax is going to be pretty close to our overall plan. And that has been a big counter to losses we've had in normal payroll withholding and in sales taxes, which I'll get into now, which is slide 12. Again, this is the first time we saw the full impact of sales taxes, and we were down a little over 12% for the month. If you add the 2 months combined, we're about 6.5% for the 2 months. Although I think, unlike payroll withholding, there weren't different days here. I think in the first month, we had a lot of hoarding going on and people continuing. And now a lot of people are just being cautious as they move forward. Thank goodness for online sales. They were up 48% for the month, while normal retailers were down 28%. We did see, though, the reports in June for actual May sales, because these are May receipts that we got in April. If you saw nationally, sales increased in May that were reported in June. I don't know if that's going to interpolate to but at least nationally, the consumer started spending again. Now, one point I would put away here is this is a much more significant impact to localities than it is to the Commonwealth. This is about 19% of our overall revenues. It's a substantial portion of locality revenues. So I demonstrated why withholding taxes were not going to hurt us as much because of the type of jobs that they were impacted by it. We're not going to be hurt as much in this either, except I do believe the localities will be, because those businesses that were impacted, the restaurants, the small Main Street businesses, that's their bread and butter. So I do expect the localities to be significantly more impacted than the state will be as a result of the type of businesses that were impacted by the COVID-19 closures. Okay, next slide, please. Slide 13, corporate income tax. I'll also say that has been surprising in June too, and I do think we'll have an opportunity for an upward bias here, although it's not material overall. It looks like we are trending well, as many businesses waited to pay us until June, along with individuals going forward. One thing that has been against the trend, recordation taxes for the first time in many months have actually decreased. Home buying activity has been slowed. Refinance activity has been slowed for two reasons. One, there were so many people trying to do it. It was overwhelming the mortgage brokers because of low interest rates. And two, many lenders, when rates got very low, decided they were not willing to lend at those rates for 30 years. When they got down to under 1 or 2%, some lenders said, I'm sorry, we're just not going to offer those rates going forward. So that, along with the slowdown in single family and multifamily housing, has called recordation taxes for the first time in many, many months to slow down. We'll see if that picks up as we go forward. Insurance premium taxes, nothing to say here other than, as I warned last month, I do expect a lot of companies. I've been seeing TV advertisements for Geico and State Farm to rebate many insurance premiums to their customers. That will cause a reduction in those taxes going forward. And also, as you know, when things get tight, a lot of people, one of the first things they cut back on is insurance. So I would expect this not to be as productive going forward, at least in the short term, based on those factors. So if we go to slide 14, this sums it up. If we were going to make our budget for the year, we would have to be up 36% in the month of June. I don't think we're going to do that, but I think we're going to be a whole lot better than where we thought. So we would have to collect $3.3 billion in the month of June to make our collections. We collected, we did about $2.4 billion last year. But if we go to slide 15, this would be the calculation. We could actually lose 5% and still be we would be down $1 billion to last year. And fortunately, we're not going to do this either. We're going to be much better than this because we're going to actually do more than we did last year. So my best guesstimate as we are now, somewhere between $500 or so million below our projections, which would put us in the position of actually growth, an actual growth over the prior year, but below our projections. And of course, we'll have that all ready to report to you guys. I think July 10th, the governor will be able to make his report on what actual sales or revenues were for the year. So if we go to the next page, the next steps are we'll monitor the remaining receipts for the last 8 days of this year. I will point out the last bullet, the accelerated sales tax. We have 2,300 accounts that qualify for this. You know, as you realize, I know most of you know, we have June sales. The big retailers have to pay us for those in June. Small retailers don't. We've had 162 of those accounts ask for a partial or full relief from that because of the COVID virus going forward. So we do expect some negative impact to that as we look at the final receipts for this year. A couple of things. The lottery continues to perform below expectations. Profits were down 13% for the month, and we're down about $58 million for the year in that revenue source as we move forward. I did report last month that both motor fuels and sales and use tax and transportation were down. They were again down this month, but not as much as the previous month, as we've seen some economic activity come back in. So that leads us to the next slide, which will be after we close out the end of this fiscal year. We will get into a new reforecasting of the budget. We're required to do this if we're below 1% of our estimates, and I believe we will be below 1%, which is about $250 million. We will be below that. On July 10th, as I said, the governor will announce the revenue shortfall. We do believe it will be a shortfall to budget, not as bad as we thought it was going to be, but still a shortfall. The July 20th is the advisory board of our economists. Of course, in between this time, our economists will be working out their economic forecast. And of course, on August 3rd, once we meet with the economists, we'll meet with many of you in the GACR, or the Governor's Advisory Council on Revenue Estimates, to finalize those estimates, all leading up to the governor addressing the joint money committees on August the 18th. We'll have that in place. Now, let me throw out to you, I think we're in a much better place in doing this forecast than we were 60 or 75 days ago. First of all, we know a lot of the uncertainties, while they're still not 100% known, we may now know how deep we were going to go into this. If the bottom was actually happened in April and May, we'll know how long. We're going to have a slow recovery, but at least we have an indication of what that pace may be. And we now know the federal government is all in, both on monetary and fiscal policy. And while that may not direct revenues to the Commonwealth, it certainly is going to underpin economic growth as we go forward. And if you look back at where economists were in April in terms of the economic forecast, almost 80% of them either had a base or a pessimistic view of where we were headed. Where we sat today, 75% either have slow growth or an optimistic view of where we're going to go. That's very important when looking at economic models because of where we may trend going into the future. In fact, the Wall Street Journal just had an article that say 68% of economists predict recovery beginning in the third quarter of this year. So that's a lot different where we were. I'm not suggesting to you we're going to have it's all clear. I have no idea what the revenue numbers are going to be, but I do believe they'll be based on a better model than they would have been 90 days ago because we have much better information to put into that model. Let me quickly wrap up. If we go to the next page, I know you're going to have a more detailed review of federal the stimulus funds, but just want to point out here, these are the actions that Congress has taken through 4 separate authorizations. Lots of money have flowed into the Commonwealth, not directly to us, but into the Commonwealth, a little over $28 billion. A lot of that is direct to grants. The payroll Paycheck Protection Program was a big part of that. Also, the USDA Food Assistance Program was a big part of that. Over $23 million have flowed in to the Commonwealth. On the next page, in addition to these specific areas, FMAP, the Federal Medicaid Assistance Percentage, was increased, which put new monies into the Commonwealth. I know you're going to have a Medicaid update, and my colleagues will update you on that. Of course, what got the most scrutiny was the CRF, the $3.3 billion that came directly to the Commonwealth. That's what we have the most greatest discretion over. We did get some grants like the education grants and other things that we had some discretion, but had to be used for specific purposes. And of course, there were a lot of programs we had no discretion over that went directly to individuals or to businesses as we go forward. Next page 20 just gives you a little bit of what we've done with the CRF funds, the Coronavirus Relief Fund. As I mentioned, we had $3.3 billion. That included $200 million that went directly to Fairfax County. So we actually had $3.1 billion for us to allocate. We have taken actions, the largest of which, about $645 million, was sent to all the localities exclusive of Fairfax, but had already received its locality monies. And so to date, we've taken about a little over $1 billion of these funds have committed. If you look at this next page here, the final page, slide 21, a quick overview. About $891 million has been allocated to those various allocations that you see listed there. The testing included prevalence testing for nursing homes and kits for the National Guard, and a general testing program. PPE is sort of self-explanatory. The VDM other are for personnel and operations not directly related for the testing efforts. It includes the military affairs and some deficits related to spending in those areas. So that got us to about $892 million. Since then, we've taken a couple more actions since this report. We had agency-based requests for the year fiscal 2020 we needed to act on quickly to make sure we got them into this fiscal year, about $90 million that primarily related to direct cost of PPE for the agencies, or testing, or sanitation, or overtime, or those personnel costs directly related to our agencies. We want to make sure we got that reimbursed before we close the end of the year. We had a continuation of the mortgage and rental assistance program. The governor announced last week about $40 million as we bringing our total to about a little over $1 billion that's been committed. Since sent this information, I think the Money Committee staff have the breakdown of all this information. We do have significant asks left to consider. That is testing and contact tracing over and above what we've already approved, a final PPE plan. Certainly what we're going to do at our higher education universities and supporting them, and certainly some additional monies in long-term care. So those are primarily will impact 2021. And so we focused on 2020 to get these out before year end. So that's an overview of where we stand, Madam Chair, with the monies in terms of our revenues and the actions we've taken for the stimulus funds. And I'm happy to answer any questions if there are any. And thank you for your time this morning.
Thank you, Mr. Secretary. You know, this is difficult times, but compared to what you told us last time, this is encouraging. Our numbers are down, but they're down half of what we had expected them to be. So I guess we will be able to get out of this, hopefully without a second outbreak. Are there any questions?
Yes, Janet, can you hear me?
Yes, Sazel.
Janet, Aubrey, let me ask you something. We unallotted a few weeks ago, $2 billion, I think $2.1 billion. Of that, how much do you think we'll be able to put back if you had to take your best guess at this point?
So, Senator, I'm not going to take a best guess because I'm sure it'll be wrong. And I don't mean that to be flippant, but as I said before, I don't know if the forecast is going to be a lot better or the same or worse. I just know that the forecast will be built on data that is not either unknown or without some trends as where we're going in that. So, Senator, I really don't want to get into that because I just don't know in that. And I'll also throw out, it may not be a matter of unallotting. It could be prioritization. It could be that the General Assembly and the governor may want to take some of the newer programs and substitute those for some that are in there. So I don't know that it's just a matter of unallotting. And I'm not saying that because I'm not trying to say any policy. I'm just saying that will be a determination. And I think a lot of that will be dependent upon what the actual revenue forecast will be. I just know it will be a better forecast. When I say better, it will be based on a better data and trend and there won't be the assumption of uncertainty. And when you have uncertainty, you have to always take the worst case scenario. So I'm not suggesting to you that it's going to be a lot better, but I think it'll be a better prepared forecast. And I'll also point out, Senator, I would suggest even with that, we may have to revisit this sometime again when you got in the normal session, because hopefully in a positive way, but it all depends, as I said before, and Madam Chair, you just said it, it depends on how the virus acts. If we were to have a second wave, that would change a lot after we do this forecast.
If I might ask, just to follow up on that, what kind of a process do you have in mind for making those priorities?
I don't have it. I've talked with the governor's office about this and asked them to be thinking through it. We've been so tied up getting through the end of the year, but I think it will be the level of revenue may dictate what the process would be. And I say that not again because I have any direction from the governor or the policy team, but for instance, if in fact, let's just say the forecast came in right at $1 billion less each year, what we're thinking it's going to be, that may be a different conversation than if it were increased or if it was a lot less. And so I would suspect that the process would be once we knew that, and I think we're going to know that around the the first part of August, right before the Gaker meeting, then I don't know if the governor is going to go through a normal process where he would say, here are his recommendations, or how that may work. But I do think the level of revenue may dictate the process.
I would, not surprisingly, stress that I think it's really important that the legislature be involved every step of the way, because we're not going to have lots of time to make decisions once that starts happening with the re-allotting or whatever we're going to call it. It's going to have to go quite quickly, and for that to happen, I think we as the legislature need to be involved heavily right from the beginning.
Yes, ma'am. I think that's the expectation. I would also say that may dictate when exactly the special session would be. In other words, it may take a little more preparation depending on what the revenues are and what actions need to be taken. So I just bring that up. I know the governor will and his policy team work with the leadership as we move forward. But I would think we would have a better decision process once we sort of had a very good idea, the ballpark of what the reforecast is going to look like. And we should know that around August, the 1st of August or so.
Okay, thank you.
At least for internal deliberation, not for public consumption, but internal deliberations.
Are there other questions?
This is Emmett. I've got a question for Secretary Lane.
Emmett, go ahead.
You made reference to the moratorium on evictions, which I think is in effect through June the 28th.
Yes, sir.
And the governor was preparing a comprehensive relief program. Has the detail on that been worked out? I'm getting feedback, a lot of problems with landlords not getting their money. And of course, the checks that were sent out from the federal government, there were other priorities that people use them for rather than paying their rent. So how has a program been worked out on that?
Yes, sir. I think the governor is announcing that this week. It's effective. The reason we allocated the money, they needed a little bit of time because it's a statewide program to work with the local agencies. The program is designed, I know this, that it makes sure it gets in the landlord's hands in that. And so it's run through the Department of Community Housing and Development. And I believe the governor is announcing that this week. But the details that came out of Commerce and Labor have been worked out. Of course, we reviewed to make sure they do qualify for CARES funding. And that was the role that finance played. in that. But key to that is, to your point, Senator, they have to get to the landlord because that would be the way we would justify it in making sure it was a direct result of COVID-19.
Okay. Thank you.
Any other question?
Yes.
Senator Barker,
Senator Barker.
go ahead.
Yes. Secretary, Mr. Secretary, very good presentation and good news on a lot of things. The Gaker meeting is scheduled for August 3rd. I've been hearing that the Senate is going to take up the HEROES bill, their replacement for it basically, after when they come back after the 4th of July to deal with things, and that they want to try to get it resolved at least in the Senate during July because of the impact upon the $600 a week on the unemployment compensation, so that they're not sort of leaving things hanging out there. If, however, the negotiations with the House, it takes longer than April to August 3rd to get that all worked out, can the action of the Gaker on August 3rd have sort of an asterisk there, so that if we get between then and when we do our special session, an indication of additional federal revenue coming in, that we will be able to factor that into the budget?
The answer is yes. Of course, we'll do our forecast based on actual trends. The federal stimulus dollars, if they are allowed to be used other than for COVID-19 directly, as you know, right now, it can only be used for direct impacts. But if they were to give flexibility or additional monies that could be used for general replacement of revenues, then that would be additive on to our underlying trends. We could take those into account. I would also point out, though, even if that happens, we're going to have to be careful for the use of those monies because they would be limited in nature. In other words, they would not be reflective of the underlying economics. So we could use them for one-time things, expansion of broadband or scalable programs. I would not say we could use those monies for supporting increases in salaries, because they would not be recurring revenues in the stream of things. So I just point that out is because I do think there's a chance that that would happen, and that would help us in some parts of our budget. But it's important that we certainly understand the underlying ongoing revenue pieces for economic activity in the Commonwealth, because things like salaries or additional programs that are long-term in nature are going to have to be supported by those. But the answer to your question is they would be additive to the process and could be accounted for.
Thank you.
Any other questions?
One.
Yes, Senator.
Any chance of making that Gaker meeting July 31st or August 13th?
August 13th would be too late to get it done by the 18th, but I can check to see if there's any movements. But that was the latest we could do it and still have it ready for August 18th Money Committee presentation.
July 31st is the previous Friday, so that
Okay.
Monday, August 3rd.
I'll check to see.
Okay, thank you so much, Aubrey.
Okay, any other question? Well, thank you, Aubrey. This was very enlightening, and I do want to thank you for the leadership you give us all. We have so many difficult decisions, and it's personally, I appreciate your guidance and your wisdom and your hard work as well.
Thank you very much, and appreciate y'all having me today.
Thanks. Okay, next we have a report from DMAS, and Ellen Mons is going to be giving it. She's Deputy Director of DMAS. This is a very last minute switch because the director is not well today, not feeling well today. So go right ahead and we will back you up.
Well, good morning, Madam Chair and members of the committee. Thank you for having me here today to present on DMAS's response to COVID-19. And I will just first off say on behalf of Director Kimsey that she certainly apologizes for not being here. I think, she obviously was very excited to come and present on all the successes I think that our agency has had over the past 3 months. But as mentioned, she had a last minute family emergency and won't be here. Second, I will apologize for my lack of camera. I would like to be speaking to you all face to face, but I alas do not yet have a camera on my computer. All right. So next slide, please. All right, I'm going to go through 3 sections here. First, I'll give an update as we all enjoy of our Medicaid expansion. Second, I'll talk about the policies that DMAS has implemented related to COVID-19. And third, I'll talk about the fiscal impact of those policies as well as kind of enrollment due to COVID-19. Next slide, please. All right. Currently, DMAS offers life-saving coverage to now it's 1 in 6 Virginians. This includes more than 430,000 newly eligible adults who've gained access to care under Medicaid expansion. And as we look at these numbers, and we've presented these earlier numbers to the committee before, but as we look at these numbers, we can clearly say that coverage has equaled access for our members. And we see that our expansion members are receiving critical services and that need is truly there. I would also mention that we feel fortunate to have Medicaid expansion, and that's particularly highlighted during this emergency. Later, I'll talk about the overall increase in enrollment Medicaid has experienced since the COVID-19 emergency, but I will note here that we've had over 40,000 new enrollees enroll in Medicaid expansion since the crisis. Next slide, please. I would be remiss if I didn't take a quick pause here to talk about Medicaid as an agent for health equity. I think we've worked over the past 50 years, and as Medicaid stood for racial and economic health equity, and our mission is even more important than ever before, and that is as we've heard from other presenters in previous sessions, that the COVID-19 emergency has only served to highlight the inequities that are built into our system. And these are those that we have not yet erased, and we still have far to go. And so I did want to present today that in addition to responding to the very real emergency of COVID-19, DMAS has continued its work as in promoting health equity, as well as continued its work making sure that we have a running responsive program that ensures access to our members. Next slide, please. All right, on to our COVID-19 update.
I might just interrupt. Does anybody have a question on this part of the presentation? Okay, continue.
Thank you. All right, so COVID-19, I will begin with a brief update of our agency, our staff response to COVID-19. With the devastating health and economic impacts, the COVID-19 pandemic obviously presents a multifaceted challenge to our Commonwealth, and one that Virginia Medicaid Agency is uniquely positioned to help address. And in order to ensure we could best address these challenges and support our members, we had to very quickly adapt internally. And I did want to highlight here some successes some early successes of our agency and how we are continuing to ensure productivity under a telework environment. So first, we transitioned all of our staff to telework. And we did this in the course of 24 hours with ample planning. But on March 18th, we were able to fully transition all of our full-time staff to telework. with the addition of an opened alternative site so that we could continue to do some of our processes that required an in-person touch, such as receiving US mail. Over the past 3 months, we have been supporting our teams to ensure they have the tools necessary to be productive and in this time of COVID-19. We've sent out daily communications to our staff to ensure that they know that we are listening to them, we hear them, and we are acting. And in addition, we have set up several training sessions to help our members learn how to be better managers and more productive in a telework environment. Finally, we have done initial planning for how to transition our agency back to the building when it is time. In order to do so, we sought the engagement of our employees with several town halls. We've read the guidance from DHRM and CDC and others, and we have an initial proposal of a 4-phase plan ensuring the safety and security of our staff members. Next slide, please. Next, I'll shift to our programmatic response due to COVID-19. Overall, I would characterize our response as swift, continued, and broad. DMAS is working closely with the Centers for Medicare and Medicaid Services to secure federal funding through emergency waivers and other opportunities to support our providers and reduce strain on the state budget. DMAS has submitted 9 waivers and state plan amendments to unlock federal flexibilities aimed at ensuring the safety of our members and provider network and financial solvency of providers during the health emergency. And I will note that nearly all of our policy modifications have been completed without any additional state funds. I will have slides later that will show where additional state funds have been required. Next slide, please. All right, we'll get into the specifics of our policies that DMAS has implemented over the last 3 months. We've implemented a variety of initiatives to ensure our members, providers, and the Commonwealth at large are covered. First, I'll highlight our coverage policies. DMAS has responded to COVID-19 with a comprehensive set of policies that make sure that our members do not need to worry about losing coverage during the health emergency, that our members are ensured that they will get a timely processing of their Medicaid application, and we've worked to reduce barriers to the receipt of necessary care. These slides present some highlights of those policies. First, on the coverage front, we announced early on that we would maintain coverage for Medicaid and CHIP members for the duration of the health emergency. We also ensured that our Medicaid application processes were able to take account and disregard the additional federal funding that came to individuals with respect to Medicaid eligibility. And third, we extended the time members are able to appeal cases and ensure appeals are reviewed by managed care organizations in a timely manner. We also took steps to ensure that our members had access to care, and here we're really talking about kind of safe access to care that took into account the circumstances of COVID-19. First, we announced that we would allow 90-day supply and early refill of prescriptions to ensure our members didn't have to unnecessarily expose themselves and go to a pharmacy. Second, we swiftly acted to permit and expand telehealth services to ensure access to needed care. Third, we suspended all copays. And fourth, we announced that for certain particular services, we would not require pre-approvals. And we also extended current authorizations for critical medical supplies, devices, and services. Some examples here would include, we waived prior authorization rules for things like short-term oxygen and other DMEs. Next slide, please. So I went over the kind of coverage policy specifics, but second, we work closely with our providers to respond to their needs during this evolving health emergency through both financial support and new staffing flexibilities. Some highlights of these policies are included on this slide. First, we were able to provide some of our critical providers with financial support. DMAS is offering retainer payments for adult day health centers and providers that offer day services, including group day, community engagement, and community coaching for providers that are closed or unable to offer their usual level of services due to COVID-19. DMAS has also increased nursing facility reimbursement rates by $20 a day to support $20 a day per member to support these providers as they work to protect residents who are at high risk of serious illness from the novel coronavirus. As mentioned earlier, we were also able to reimburse telehealth services at the same rate as face-to-face services, ensuring our providers could, through different modalities, ensure access to care for our members. And finally, we additionally added a few new telehealth services, specifically the ability for providers to kind of bill for communications with one another about a member's care. We also provided new staffing flexibilities for our providers. Some of our emergency rules give home and community-based providers greater ability to sustain staffing capacity while giving them more flexibility with training, oversights, and other requirements. We also allowed spouses, parents of minor children, and legal guardians of a member to provide and receive reimbursement for personal care services. And finally, we've allowed, in cases where necessary, select services, certain services to be offered in alternative locations in order to appropriately respond to any safety concerns that arise due to COVID-19. I'll stop there briefly. I'm going to move on to some of the financials next, and I did want to stop and see if anyone had any comments on the policy components.
Madam Chair, Senator Dave Marston.
Yes, Senator Marston.
Appendix K has come up a number of times in emails to me, and I have a request in now for some clarification. Is that going to be continued to be used to help parents pay basically themselves for taking care of their kids on Medicaid waivers who are, when they are having difficulty finding people who will come into their homes and provide that care?
Sure, Senator Marston. I know that we've reached out to you and happy to have a further conversation, but I did want to, let me address that generally and as it specifically applies to your question. Our Appendix K flexibilities, we applied for Appendix K flexibilities to the federal government, and we asked that those policies remain in effect until the end of Executive Order 51. And at that time, Executive Order 51 had an expiration date in June. So now that Executive Order has been extended until the governor rescinds, we have the capability and are doing so to seek an extension of Appendix K flexibilities from the federal government. That extension, Appendix K flexibilities given to us by the federal government, we are allowed through January of next year. Now, we will release a Medicaid memo likely within the next week that will detail the end dates from a state's perspective, the end dates for all of the Appendix K flexibilities. So the team is still working on when we believe the policies, each and every one of those Appendix K policies should wind down. And there, obviously, we are taking into consideration what you just mentioned was kind of the balance between, safety, access to care, and kind of reverting back to the policies and regulations that stand. So we will have much more information very soon, but we are indeed working to extend those policies.
Thank you.
Any other question? Okay.
Fantastic. Thank you. All right. So I mentioned earlier that we were able to implement the policies that I went through at very limited additional general funding. But I did want to highlight that three of our policies did require some additional general funds. Number one, our expansion to telehealth services. And here, the funding required there was to fund a new service that is not currently covered, and that is remote patient monitoring. Second, there was some additional funding to suspend out-of-pocket costs for our members. Currently, out-of-pocket requirements, co-pays, for example, are only required in our fee-for-service program and in our FAMOUS program. So there were costs associated with the suspension, again, very minor, of out-of-pocket cost requirements for our members to ensure that there was not any barrier to our members accessing needed care. And third, as I mentioned, we suspended limitations and pre-authorization requirements for critical medical equipment and devices. We did estimate kind of a small, a small impact in our fee-for-service. I will note that in by and large, with respect to our managed care plans, and as you all know, over 90% of our members are in managed care. We were able to execute our policies and implement our policies in partnership with our managed care plans at no additional cost to the state. That is, our managed care plans were able to cover all of our additional policies using the existing capitation payments that we give to our plans.
Probably till noon.
And finally, we will have, as I noted before, we were able to cover the additional $20 per diem for our nursing facilities. And I'll have a more specific slide next. We were able to cover the additional $20 per diem for our nursing facilities in our fiscal year 20 rates, but we will require additional funding in fiscal year 21, particularly if the emergency continues on through the year. Next slide. As I mentioned here, we implemented you all directed us to implement an increase to nursing home and specialized care per diem rates by $20 per day per patient. As of just a few days ago, DMAS has made payments of $2.66 million in fee-for-service payments under this program, and our managed care plan partners have made about $18.3 million in additional payments. So, and that's for payments likely through the end of May. And so we have about $21 million that has gone out to nursing homes for patient days between March and May. As I just mentioned, these payments will continue until the governor's state of emergency, Executive Order 51, is ended. And this will require additional funds in fiscal year 21, which we are currently working with our actuary to determine the amount, and will be included in our reforecast. Next slide, please. I did also want to mention the role that the federal funding has played in DMAS's consideration of our response to COVID-19. As mentioned previously, DMAS has received an increase in our federal matching assistance percentage of 6.2%. And that impact has brought an additional $375 million in federal funding in state fiscal year 2020 for Medicaid and CHIP. Now, as I mentioned earlier, the receipt of this increase in FMAP does require us as a state to maintain continuous coverage for our Medicaid enrollees, which we have gladly done, and we have provided that security for our members. The end of that, currently the end of that increase in FMAP is tied to the end of Secretary Azar's federal emergency declaration. Currently, that emergency declaration is set to end in July, and which would mean, if not extended, and I won't prognosticate whether they will extend it or not, but if the emergency federal declaration were to end in July, the increased enhanced FMAP of 6.2% percentage increase would end at the end of September. So it is in the law that the enhanced FMAP will end with the last day of the quarter in which the emergency expires. Additionally, as Secretary Lane mentioned, Virginia has received $3.1 billion of the $150 billion state and local support from the Treasury's Coronavirus Relief Fund. Several of our providers have received PPE through these disbursements, and as I will note later, DMAS has asked for has submitted CARES Act funding requests that would provide additional reliefs for some of our critical providers. And finally, in terms of a source of federal funding for our Medicaid providers, HHS has dispersed millions of dollars from the Provider Relief Fund, and that has come in several forms. And thus far to date, Virginia, $75 million has gone to Virginia hospitals in high impact areas. $1 billion overall has been provided to 4,200 Virginia Medicare providers. And an additional $31 million has been provided to our FQHCs, our federally qualified healthcare centers. Additionally, HHS announced, I believe about a week and a half ago, that an additional kind of $25 billion in funding, although we don't know what portion of this will go to Virginia because our providers are only beginning to seek this additional funding. $10 billion of that funding will go directly to safety net hospitals, and $15 billion of that $25 billion will go directly to Medicaid providers who have not received funding under the Medicare disbursement of funding. So details here remain a bit gray, and we're seeking clarification from HHS. But we have done outreach to our Medicaid providers, encouraging them to go to the portal that HHS has established and apply for relief funds that they may be eligible for. Next slide, please. All right, I mentioned earlier I would talk a bit about Medicaid enrollment and the increase we've seen since the March 12th declaration of the state of emergency. So since the state of emergency was declared, Medicaid has gained about 91,000 new members. Of these 91,000, about 40,000 are in Medicaid expansion, 32,000 are children, and the remaining kind of 20,000 or so are pretty much distributed between our other populations of coverage, with the largest tranche coming from our parents who are not in our Medicaid expansion population. This means that on average, Medicaid has gained 900 new members each day. If you're asking the question, how does this relate to what we have forecast? The growth is about, depending on what day you ask me that question, the growth is about 60,000 members more than we forecasted over the period. Another question that we receive often is, how much of this enrollment is related to our policy to ensure continuous coverage over the state of emergency, and how much is due to new individuals who have, for example, lost their job coming to newly sign up for Medicaid. That's certainly a difficult question to answer. We are attempting to tease apart these two different components of our enrollment increase. What's difficult in doing that calculation is that we have to remember that many of our Medicaid members who would have otherwise kind of rolled off, and for example, because they've gotten a job that has Medicaid coverage, many of those members, we would not expect to experience that under these circumstances, and they would otherwise remain enrolled in coverage. So we are working to kind of tease out the effects of the continuous enrollment policy from the new enrollment sparked by the decline in our economic conditions. But we will have more and are working on that, particularly with our forecasting efforts. Next slide, please. All right, so talking about our DMAS fiscal year 20 agency year-end balance. I'll just take a moment to focus on our last row here, showing that we are projecting a year-end balance of about 84 million. Now, this reflects the net of a few items that I've mentioned before. One is we have had increased enrollment in the Medicaid program. Two, we have had an increase in our federal matching percentage. So that increase in enrollment has been more than offset by the increase in the federal funds that we're receiving in Medicaid. Third, we have experienced, as we talked about before, we've experienced a pretty sizable decrease in utilization of services in our Medicaid fee-for-service population. That's not a surprise to anyone, particularly with the moratorium on elective services, and also, just our general knowledge that we're not going to go out to our dental appointment, or we may reschedule that primary care visit. And so we have experienced some decrease in utilization in fee for service. And so really what the 84 million there represents is in fact a kind of greater than expected pharmacy rebates that we've experienced in this fiscal year. And that was over forecast. That was $78 million over forecast. So that is really truly driving our balance in this year. As I think we've said before, projecting pharmacy rebates is a difficult thing to do, but always good when it's unexpectedly in the positive here. Next slide. I will wrap up with just noting that our response is not over. It continues, and we are also planning for any resurgence of COVID-19, knock on wood, while we are also planning for winding down our new flexibilities. So, we are planning for unwinding any of our new flexibilities, as I talked a little bit about with Appendix K earlier. We are also identifying policies that may be beneficial long-term. We get a lot of questions about telehealth, for example. How would we propose, now that we have seen the adoption of telehealth and the benefits of telehealth, how might we think about a longer-term strategy on telehealth? And as I mentioned before, we have submitted some proposals for the Coronavirus Relief Fund, and we are working on some payments to to temporarily enhance some of our provider payments through our managed care plans, and this can be described as such. So we know that we are over the past 3 months. I mentioned the decrease in utilization that we've experienced, over the Commonwealth and over the nation in medical care, and that means that there are money in our capitation payment rates that we've paid our managed care plans that we may be able to direct to some of our providers that have yet to receive any much federal support or any kind of direct state support. So we are working currently with the administration and our managed care plans to explore how we might temporarily provide some enhanced payments to our providers in our managed care plans. Next slide. I think we just wanted to highlight that our response has not been driven in a vacuum. We continue with feedback loops to all of our partners in working in partnership, but also communicating back and forth with our members, our stakeholders, our providers, our national and state work groups, and our sister agencies. And finally, next slide. All of the policies that we have implemented are included on our website, and the links for those and a specific COVID-19 page on our website, and the links for those are included in this slide. And that is all I have for us today, and I'm happy to take any questions.
Are there questions for Ellen? Well, thank you very much for stepping in at the last half hour. So that was wonderful. I appreciate it. And,
thank you very much.
Thank you for the presentation. Okay, next we're going to hear from our own staff with an overview of the federal relief funding. This is going to make our meeting go perhaps another half hour, but I am anticipating we're going to have a very, very meaty meeting next time, and I'd like for you to be up to date on this. So April, if you could give the overview.
Thank you, Madam Chair. As mentioned, this is going to be a quick overview of federal relief funding for Virginia, as Aubrey did cover a few things and Ellen actually covered a few more. But we're going to start off with that overview on, if you look at slide 2, we're going to move on to general assistance to state governments. And then we're going to get into some area specific information related to health and human services, education, and then some other state programs. The staff is going to conclude with a summary of programs for individuals and businesses. And then in the appendix for your information are those allocations by local government and local school divisions so that you have those for your reference. Moving on to slide 3, I'm going to turn it over to Mike to do the overview.
Thanks, April. This is Tweety. So this slide just gives you a quick timeline of the COVID-19 emergency. It's kind of for your background. So as you can see, by late January, the concern was starting to be raised. By the time you get to March, especially mid-March, the first cases had appeared in Virginia, and the governor declared the state of emergency and took the measures to slow the spread of the virus. And of course, since May 15th, the restrictions have been slowly starting to be lifted, to reopen Virginia as improvements in all the data has been positive. So as previously mentioned, this just lists the 4 federal actions that Congress has passed and the president signed from everything. The first bill, the first three were all passed in March. The first one was very small and narrow, focused on the public health response. And the first major bill was back in March 18th, the Families First Coronavirus Response Act, that basically was almost about a $200 billion bill. It started to focus on the employment disruption by providing some assistance for paid medical leave, things like that for employees, as well as the enhanced federal match actually was authorized in that bill. And there were a variety of other grant program increases and funding for COVID-19 testing. The third one is the bill that you will hear the most about and spoken throughout this presentation, the Coronavirus Aid, Relief, and Economic Security Act. That's the CARES Act. That's the big one, estimated at over $2.22 trillion, provide everything from support to businesses to the Paycheck Protection Program, stimulus checks of $1,200 to individuals, the enhanced unemployment benefit, the big fiscal relief fund for state and local governments, also emergency funding for healthcare providers, and many other grant program increases. And lastly, the fourth bill was passed later in April. That one was supplemental to the Paycheck Protection Program, mainly to provide more funding for small businesses, but it also included additional funding for the Provider Relief Fund of another $75 billion, and then $25 billion for coronavirus testing. This slide just gives you the summary. Aubrey also talked about this as well, but as of the most recent data that you could find, about $7.1 billion in direct federal grants have been allocated to Virginia. $4.6 billion is really comes to the state or to state agencies. So this includes the largest chunk is that $3.1 billion for state assistance. There's over $305 million for K-12 and the Governor's Fund for Education, $456 million for transit and numerous other grant programs. $1.7 billion has been provided directly to healthcare providers from the federal government. These are all to Virginia healthcare providers. About $344 million directly to higher education institutions, $135 million to a variety of other local government and community organizations, grants, and $310 million to airports. And then there's not included in the $7.1 billion is at least, we anticipate at least $650 million in additional federal Medicaid matching funds. That could be more or less depending on when the state of emergency ends. And then just to note that over $14 billion has been provided to small businesses through the various like paycheck protection programs. And this slide just kind of gives you a quick summary of different major grant allocations. You can see the largest chunk is the relief fund, but then other funds for education. And the only other one to note is that there has been over $240 million provided to Virginia from the Centers for Disease Control, and this is focused on the public health response. And just to conclude this kind of overview, just to give you a reminder of federal assistance in prior recessions. If you go back to 2001 and kind of the dot-com recession, the feds did provide relief at that time. That was a milder recession, so they provided about $5 billion to states in each fiscal year for government services, and then did an enhanced Medicaid match of almost 3 percentage points for 5 fiscal quarters. And then the Great Recession, of course, which was much deeper back in 2008, resulted in the American Recovery and Reinvestment Act of 2009, which was the bill that provided over $53 billion to states to assist them, as well as an increase in the Medicaid match rate of 6.2 percentage points. And of course, an increases in many other federal grant programs. It's estimated that R provided states with almost $275 billion in grants, contracts, and loans to assist them, with Medicaid being about $100 billion of that amount. So with that, I'll turn it back over to April.
Thank you, Mike. If you go to the next page, I won't spend very much time here as we have mostly covered this already. Ellen mentioned this increase to the Medicaid match range, and I believe Aubrey as well. But that federal match rate change increased by 6.2 percentage points. It goes for each quarter. It began in January 31st. It is possible that it would get extended in fiscal 2021 for a longer amount. If so, that amount in the chart, that $330 million, would likely double. It does not apply to the Medicaid expansion population, and it really is sort of the most flexible funding that the state has to offset our revenue loss. Going to slide 11. On this next slide, again, most of this has been mentioned before, so I won't spend a lot of time on it. The Virginia's share of the coronavirus relief fund under the CARES Act is $3.3 billion. It was mentioned that Fairfax County was eligible to get a direct payment. I do want to just make the point again that you cannot use it to offset the Commonwealth's revenue shortfall, and the expenditures have to be directly related to the COVID-19 pandemic and spent between March 1st through December 30th. And then just lastly, as far as allocations to the localities go, there is no requirement that you do that, but it is limited to 45% of the overall state allocation. Moving to slide 12. Aubrey mentioned a lot of this information, so again, I'll cover this quickly, but as far as allocation and uses of the CRF, about $645 million went to the localities. I mentioned that those allocations by locality are in the appendix if you would like to look at that. The remaining agencies submitted proposals in May on the remaining state share of that $1.8 billion. And as of Friday, the governor had allocated about $390 million for testing, contract tracing, PPE, housing assistance, and long-term care facility support. The rest of this page just has some Treasury guidance on how the funds can be used. Some example include testing, obviously, PPE, emergency medical response, telemedicine, things related to distance learning, food delivery, employee teleworking, expenditures related to the homeless population, and then some ability to do grants to small businesses to do things like payroll support programs, and then unemployment insurance costs that were not otherwise reimbursed. Moving to slide 13. More importantly, agencies submitted over 400 requests. I believe it's about 430. Those requests totaled to $1.2 billion. The chart gives you the breakdown by secretarial area to the left here. The majority of those requests you'll see that are all above 300 million each were to the areas of health and human resources, education, and commerce and trade. Moving to slide 14. The staff chose some categories that were in common among those over 400 requests. And what we found were that the majority of the requests were for individual assistance, testing and contract tracing, and then agency programs and services. But here on this bar chart, you've got a look at those categories that were chosen and sort of the percentage breakdown between those requests. Moving to slide 15. This just gives you a little more detail as far as the largest agency requests. And these are sort of all the agencies that had requests starting at about 30 million and above. I'll just mention a few. The University of Virginia, their requests totaled to 260 million. The majority of those requests were for statewide testing, and some other items included PPE, other equipment, and then some payroll expenses. The Department of Housing and Community Development is next at about 235 million. Most of that, or about 200 million, is for that rental and mortgage relief program that Senator Saslaw had mentioned earlier. And then some additional funding for homeless assistance and broadband access. The next agency at about 170 million was Department of Social Services, and they mainly were requesting funding to provide a similar stimulus benefit to immigrant families that are not eligible due to not having Social Security numbers. And then the last agency that I'll just specifically mention is DMAS, who was up earlier, and their requests were for about 120 million. Most of that were for payments to Medicaid providers or items related to either PPE or sanitation and cleaning. Moving to the next slide. On this slide, this just provided just a little information on other states and what they're doing with their oversight of the coronavirus relief funds. Most importantly, as I tried to think about this information in categories, you'll see in the light green color, these are what states have already provided funding and allocated it to the locality. So you'll see a number of states have already done that, about 14. And as far as the other categories, I look to break it down into how are they making the decisions, and a number are doing advisory or oversight groups with input, which may or may not include legislative members. Some states are exclusively having decisions at the executive level or the governor level. And then there are, in the light blue, you'll see there's a few states that have passed legislation specifically to allocate that funding. And the states in gray are just where there was no state-specific information included. And Mike, if you could go to the next slide. I'm going to turn it over to Jason to talk about the municipal liquidity facility.
Thank you, April. And in addition to the funding available through the Coronavirus Relief Fund, which has been mentioned cannot be used by states to offset revenue losses, The Federal Reserve has established the Municipal Liquidity Facility, or MLF, as a lending program that is intended to help state and local governments manage cash flow stresses caused by the current pandemic. Under the MLF, the Fed will purchase up to $500 billion in new short-term notes from states and certain localities for operational expenses. These bonds would have a 3-year maturity with interest rates ranging between 1.5 and 5.9%. With associated servicing costs, Virginia's assumed true interest cost would be around 1.6%. Because this program is intended to be the lender of last resort, the current rate is likely higher than what a AAA state like Virginia would see in the competitive municipal bond market, and to date, Illinois is the only state that has accessed the program. State and local governments may use these proceeds to manage cash flow issues caused by the extension of the income tax filing deadline, or to cover revenue losses and other expenses related to the pandemic, including debt service on any outstanding bonds. Under current MLF guidelines, last revised on June 3rd, only states, counties with populations greater than 500,000, cities with populations in excess of 250,000, and qualified multi-state entities are eligible to directly access the MLF program. Mike, if you could change the slide, please. Based on these requirements, only the Commonwealth, Fairfax County, the City of Virginia Beach, and the Washington Metropolitan Area Transit Authority can directly tap into the Federal Reserve Program, and all other units of local government or political subdivisions are required to go through the state. You will recall that 2 separate actions taken at the reconvened session authorized emergency 9A and 9D debt totaling $750 million for the fiscal year ending June 30th, and a separate $750 million for the next biennium that would be eligible for purchase under the MLF program. Of these amounts, $500 million can be used to address state operational needs, and $250 million could be used to benefit local governments. It is important to note that the FY20 authorization does expire if not issued prior to June 30th. As Secretary Lane noted, Virginia is estimated to be eligible to borrow up to $7.3 billion under the current structure of the program, and at the moment, the MLF remains another tool in the toolbox to address cash shortfalls to both state and localities as the current fiscal year comes to a close. Before we proceed to specific programmatic funding by policy area, we will pause briefly for any questions on the overview.
Any questions? Okay, keep going.
Moving on to Health and Human Resources. So just to start off, the federal assistance for public health programs, of course, most of that is directed to the Virginia Department of Health, which so far had received, in addition to what I'll talk about on the next slide, over $240 million for the public health response. So you can see that they've received some in each iteration of what Congress has passed, as well as some other smaller programs. And some funding has flowed directly, over $33 million, directly to entities like community health centers and poison control centers, et cetera. So with regards to the big chunk of money for public health actually came for COVID-19 testing. This was in the 4th bill Congress passed, which provided $11 billion directly to state and local governments for COVID-19 testing. Virginia's allocation was $213 million, and that funding is to be used for every aspect of COVID-19 testing, but can also be used for conducting surveillance activities related to the public health response, as well as contact tracing and other related activities. So this pot of money, so the total that they received is just over $240 million. The positive thing is that the Coronavirus Relief Fund does not have to be used for much for this cost, because this separate source of funding has actually been provided. But that's the core of what's been provided for the public health response. Just to give you another sample of other human service programs, there are many federal programs in HHR. Just to give you an idea of what else they've been doing. For example, the Child Care Development Block Grant, Virginia received about $71 million in additional funding. That was really to provide additional assistance for child care providers, since, of course, a lot of them lost enrollment because of stay-at-home orders or unemployment, and people could no longer take their kids to child care. So, of course, additional funding was provided to try to keep them open, as well as additional changes to allow people who had to work, like healthcare workers, to continue to have access to child care during the emergency. Other programs like the Low-Income Energy Assistance received additional funding. Services for the elderly also received funding. This was mainly to focus, like, for example, to provide more home-delivered meals for the elderly, since they could no longer attend day programs that they otherwise would have. That just kind of gives you an example of some of those. In HHR, the last thing I'll talk about is the direct support for healthcare providers. This does not flow through the state, but it is important in the sense that through two separate appropriations, the federal government has provided $175 billion for reimbursement to healthcare providers, basically due to COVID-19 related expenses or lost revenue. So as of June 15th, what the federal government reported is that Virginia providers have been awarded nearly $1.7 billion. It's through, you can see it's actually broken out into multiple distributions. They primarily used Medicare data to distribute it, but they've also provided funding for high impact hospitals that treated a lot of COVID patients, as well as providing support to rural hospitals and clinics, direct support to skilled nursing facilities, as well as safety net hospitals. And as Ellen mentioned before from DMAS, that they are now working on an additional distribution for Medicaid-only providers. It's possible that could come later in July. So those are providers like the developmental disability waiver providers that are pretty much all they do is provide Medicaid services. And so far they haven't received anything. Moving on to education, Tyler will take it from here.
Thanks, Mike. The CARES Act provided states $30.8 billion for relief funding for elementary and secondary schools, higher education, and for a governor's emergency relief fund, which allows each governor to provide emergency grants to K-12 and higher education institutions. Virginia's total allocation from the CARES Act for education is $625.1 million. Mike, if you can go to the next slide. Virginia received $238.6 million for K-12 schools. 90% or $214.7 million of these funds went directly to the local school divisions. Divisions are given wide latitude in how to spend these funds, which it could include distance learning and cleaning supply costs, for example. 10% is reserved by the Virginia Department of Education for statewide efforts to support the school reopening plan. Most of these funds will be used as grants to assist school divisions. These funds do require maintenance of effort in fiscal year 20 and fiscal year 21. Moving on to the Governor's Emergency Education Relief Fund. Virginia was allocated in total $66.3 million, which the governor could distribute however he would like to K-12 or higher education institutions. The administration announced plans to distribute $43.2 million to public education. A major use of these funds is to support distance learning, with $18 million provided as grants to divisions for purchase of laptops and mobile Wi-Fi hotspots, and $8.9 million provided to support long-term broadband access through implementation of the Virginia Telecom Initiative Plan. Other planned uses for these dollars include $10 million for expanding Virginia Preschool Initiative access in the fall, $3.5 million for upgrading the state learning management system, Virtual Virginia, and $3 million to cover non-reimbursable costs for school meals programs. Sarah will now talk about the higher education funding.
Turning to higher education, as the subcommittee members heard yesterday afternoon at the meeting, 90% of the funding was allocated to institutions by formula based on a weighting more heavily towards the FTE enrollment of Pell eligible students. The chart on the right shows the Virginia formula-based amounts for the public institutions as a whole, private nonprofits, and the for-profits that was released back in April. To give you an idea by institution, for the publics, the totals range from a little over $20 million for George Mason University to about $789,000 for UVA-Wise. Among the nonprofits, the largest allocation was $15 million for Liberty University. And among the for-profits, the largest allocation was $16.8 million for ECPI. Of these totals, at least half must be used for student emergency financial aid grants. CARES Act also reserved 7.5% of the total for minority serving institutions and 2.5% at the discretion of the Secretary of Education, indicating a priority to schools that had not otherwise received aid. And there was an initial distribution announced for these that has since been pulled back by the U.S. Secretary of Education. Moving to slide 29. For the portion of the Governor's Emergency Education Relief Act for Virginia, which was about 1/3 of the total $66 million in this pool, it was basically for 4 separate uses. Those first 2 sub-bullets total about $19 million, and they're allocated based on the state's new financial aid model by institution for the 4 years community colleges, as well as the TAG eligible institutions. The remaining funding is allocated for the community colleges and higher education centers, including for last dollar scholarships for displaced adults earning stackable credentials,
and extending internet access into parking lots. On slide 30, just to put these federal amounts into a bit of perspective relative to the total impact. In the very early days of the shutdowns in March, the Council of Presidents attempted to estimate their immediate expenses, especially for technology and cleaning, and their lost revenue, which was especially in the auxiliary services of housing and dining. And at that time, those totaled very roughly $300 to $475 million. These figures will be updated with actual figures in the coming weeks, but it's likely that these actual expenses and lost revenues will exceed the CARES Act funding. To wrap up, for higher education, it should be noted that the institutions, again, subsequently submitted requests for portions of the CRF as well as through VDEM. And this presentation also does not mention the significant relief to student loan borrowers that was provided through various federal acts. And Charles will pick up with other state programs.
Thank you, Sarah. Madam Chair, this next slide just summarizes the CARES Act funding in housing and community development. The CARES Act provides $5 billion for the community development block grant programs, and to date, Virginia has been allocated $31.2 million. There's also additional amounts that are available for larger, mostly urban localities to access directly. We are also expecting an additional allocation of between $10 and $20 million. Some of the uses for this funding could be small business relief, retooling manufacturing facilities for PPE, food security, construction, rehab for shelters, testing facilities, and the like. The next largest item is emergency solutions grants. $4 billion is provided. $31 million has been allocated to Virginia, and this will be used primarily to address the need for social distancing in shelters, hotel motel vouchers, and for transitioning to permanent housing. The Housing Opportunities for Persons with AIDS program is a federal program that makes grants to local communities, states, and nonprofit organizations for projects that benefit low-income persons living with HIV/AIDS and their families. This program was provided $65 million in the CARES Act, and $178,000 was allocated to Virginia. Virginia was allocated $23.3 million under the Low-Income Home Energy Assistance Program, and 15%, or about $3.5 million, may be allocated to the Department of Housing and Community Development for its weatherization program. The balance is allocated to the Department of Social Services for its heating and cooling assistance program. However, I should note that because of concerns about spreading the virus, many people are cautious and wary about letting contractors into their homes, so it's unlikely that this $3.5 million will stay with DHCD in the weatherization program. And lastly, the CARES Act provides $1.25 billion to public housing authorities for tenant-based rental assistance. There have been at least 2 tranches of funding released that together total over $18 million in awards to Virginia housing authorities. The largest recipients are the Richmond Redevelopment and Housing Authority, $4 million, the Norfolk Redevelopment and Housing Authority, $2.7 million, and the Fairfax County Redevelopment and Housing Authority received just about $1 million in the second tranche. Next slide, please. So this slide summarizes the major unemployment compensation provisions included in the CARES Act. The committee heard from Commissioner Ellen Marie Hess with the Virginia Employment Commission at the May 19th meeting, so it's not necessary to go into a lot of detail here. But just quickly, I'll cover first, the CARES Act provides for an additional $600 per week in federal pandemic unemployment compensation. That, of course, is in addition to the regular unemployment compensation. And including the additional $600, the maximum weekly benefit in Virginia is $978, which includes the regular unemployment compensation payment of a maximum of $378. The law also provides 13 additional weeks of benefits for a total of 39 weeks, and that applies to both the regular unemployment compensation amount and the additional $600. The CARES Act also provides up to 39 weeks of unemployment benefits for those unemployed because of COVID-19, including the self-employed and those otherwise ineligible for regular unemployment compensation. Madam Chair, that's a summary of unemployment compensation. Next slide.
With respect to funding for public transit programs, the CARES Act provided $25 billion in funding nationally, and Virginia's statewide allocation totaled approximately $456.3 million. From those amounts, $356.6 million was distributed directly to large transit properties by the Federal Transit Administration, leaving approximately $100 million to be allocated by the Commonwealth Transportation Board for rural and small urban transit properties. With this program, no state or local match is required, and the total funding allocated under the CARES Act is approximately 3 times greater than the amount of federal funding for Virginia's transit programs in the current fiscal year. Next slide, please. The Commonwealth Transportation Board met on April 21st of this year and allocated approximately $81 million of the funding that required allocation by the board, and voted to retain slightly more than $19 million of this funding in reserves to address the future cost impacts of coronavirus on transit operations over the course of the year. Next.
Madam Chair, in the area of public safety, the CARES Act includes an appropriation of $45 billion under the Public Assistance Program. Under existing Public Assistance Program guidelines, states are eligible for reimbursement of up to 75% of eligible costs related to emergency protective measures, which in this case can include emergency medical care and purchase of PPE. There is also an additional $100 million under FEMA's Emergency Management Performance Grant Supplemental Program. Virginia's allocation is $2.3 million, and this can include the funding can be available for planning and operational readiness for preparedness and response, development of tools and strategies for preparedness and response, and ongoing communication among the partners. And finally, there's $850 million under Justice Assistance Grants, which are also known as Burn JAG grants. Virginia's allocation is $16.2 million. But that includes $5.3 million that's earmarked for localities. And there's language that allows the state share to be used for overtime, equipment, hiring, supplies, training, travel, and also costs related to medical care for inmates. Next slide, please. Under veterans, the CARES Act adds $150 million. Under the State Home Grant Program, this can support modification or alteration of existing state veterans homes to prepare for, prevent, and respond to the coronavirus. These funds require a 35% state match, and the biennial budget allocated $1 million in bond proceeds for the match. And there is additionally $2.1 billion total for medical community care, and Virginia's allocation will be based on eligible claims. And finally, I'll just mention that there is language that loosens some of the requirements surrounding per diems for state veterans homes and authorizes the secretary to provide PPE and other equipment. I think Adam follows me with information on general government.
Thanks, Caitlin. So the CARES Act includes $400 million in election security grants for states to prevent, prepare for, and respond to coronavirus for the 2020 federal election cycle. Of course, that includes the congressional primary that's occurring today, and then, of course, the November general election. And Virginia's share of this funding is $9.6 million. So while it wasn't clearly specified in the CARES Act, it's considered supplemental HAVA funds, Help America Vote funds, which require 20% or $1.9 million state match to access those dollars. And those can be met by either depositing funds in the state election accounts or incurring eligible expenditures to meet the match requirement by March 27th, 2022. Per the U.S. Election Assistance Commission, the CARES Act grant funding may be used for previously unbudgeted costs related to coronavirus that are considered to be allowable, allocable, and reasonable. So these can include, but are not necessarily limited to, the protection and health and safety of workers, staff, and voters during the federal election. So that's PPE, cleaning supplies, and so forth, as well as costs resulting from unanticipated increased demand for voting by mail, such as printing ballots and postage, and costs related to ensuring both the physical and cyber security of the elections. And I believe we're moving now into the summary of programs for individuals and businesses.
Thanks, Adam. So just to kind of conclude, so Just to note other things that were included in the bills that would benefit Virginians. I won't go into great detail because you've probably heard about most of them, but direct support for individuals was provided through economic impact payments or stimulus checks. Those are the $1,200 for individuals, and then some additionals for having a kid. The Congress had also provided the Emergency Family Medical Leave Expansion Act, so it was providing some additional family medical leave for employees that had to stay home to care for a child due to closures, as well as an emergency paid sick leave that provided up to 80 hours of paid sick leave for certain full-time employees, and certainly had exclusions, but there were tax credits for employers or the self-employed to help offset the cost to an employer. And then lastly, the direct support for businesses and employees. The Paycheck Protection Program is the biggest one, provide forgivable loans of up to $10 million to cover costs for self-employed individuals or private businesses with smaller than 500 or fewer employees, and as well as economic injury disaster loans, which is a low interest rate fixed loans to help businesses pay for expenses. Between those two programs, they've provided over $14 billion in support to Virginia businesses. So with that, as April said earlier, the appendix just includes additional information about the locality distributions, for example, right here, of the coronavirus relief fund, the $644 million. And then at the very end, you will also see for your references the elementary and secondary school relief allocations. So with that, Madam Chair, that concludes the presentation.
Thank you. That's impressive, all of you. Any questions for any of the staff? Okay, well, that completes our agenda. I do want to put my hats off to our spectacular staff. This is usually a relatively quiet part of the year for them, and I think they're working as hard as if it were in the session, and putting up with being at home and having your children around your feet and everything else that's going on. I'm extremely grateful to you, and I know the whole staff, our whole committee is as well. So thank you all. And with that, let's adjourn.
Thank you, Madam Chair. I also wanted just to quickly thank Senate IT, but we'll be in touch with the sponsor for those of you still on for today's meeting.
Yes,
thank you.
April, great staff.
Thank you.
Thank you.
And we're adjourned.
Bye, guys.